This video covers real options, and in this video I'm going to describe what a real option is, the different types of real options, and then two methods to value a real option. So what is a real option? From Investopedia, one of my favorite sources of information, they define it as an alternative or choice that becomes available with a business investment opportunity. It's not a derivative instrument, but an actual option in the sense of a choice that a business may gain by taking certain endeavors. For example, by investing in a particular project, a company may have the real option of expanding, downsizing, or abandoning other projects in the future. I'll give you an example of a few of those in a minute. Other examples of real options may be opportunities for research and development, mergers and acquisitions, and licensing. They're referred to as real because they pertain to tangible assets, unlike financial options such as calls or put options on stocks or bonds. The underlying asset in those cases is a financial instrument. In these cases, it usually represents some kind of tangible asset such as a building or a piece of equipment, or even an investment into research and development. There's four kinds of real options that we'll talk about. The first is an abandonment option, and this is an option that allows for a project to be abandoned early or reduced in size or scope. So an example of this might be a gold mine. So the reason why a company may want to have the opportunity to abandon mining in a drill mine or reducing that mining is because the price of gold may fall, and so it may not be worthwhile anymore. And we see this a lot with natural resources. Drilling rights and contracts with oil producers or coal producers may in fact have in them this option of abandoning it early or reducing the amount of drilling or bringing those resources out of the ground based on the price of oil or the price of coal or whatever natural resource it is. So it may be something that it makes sense to be able to abandon that in the future. A growth option is an option that provides the opportunity to expand the amount of sales into new geographic areas or into new products. An example of a growth option would be when Walmart initially went into China. With their first store, they knew it was going to lose money. So if they would have used just regular capital budgeting techniques to evaluate whether or not they should put a store in China, they would have turned it down. But they saw it as a growth option. They knew that they needed to put a store there in order to figure out all the things that they needed to fix. So were the sizes of their products the correct sizes? With the Walmart culture transfer to China, and it really didn't very well. What needed to be fixed in order to expand into China? They knew that first store wouldn't be profitable, at least for a while, wouldn't have the necessary cash flows to justify itself, but they saw it as a growth option to get into more trade overseas. A flexibility option is an option that provides the opportunity to change products or services delivered or the inputs used. And modern energy plants oftentimes have flexibility options in that they're designed to use more than one kind of energy input. So for example, many years ago when they would build an electric plant, they would build it so it only used coal. These days, many electric plants are designed to be flexible. There's an additional cost in doing that. However, they can be switched to natural gas if natural gas becomes much less expensive than coal, or they could be switched back to coal, or they can use other types of inputs. So having that flexibility allows them to save money in the long run. And then finally, an investment timing option is an option that provides the opportunity to wait until maybe a better time or some uncertainty is resolved, so companies can wait to invest in a project. So an example of this would be companies or industries that have a lot of patents and barriers to entry to getting in. So if I'm considering investing in a new technology, I might want to wait a year or two just to kind of see what happens in the marketplace to see if it would be a good idea. But the only way that I can do that is if I have a patent or copyright or something that keeps someone else from coming in and competing against me. A great example of this is something that happened a few years ago with media players, especially Blu-ray and HD DVD. And many of you may not know what I'm talking about when I say HD DVD, so you kind of know how this ends. But a few years ago, there were competing technologies in high definition video players where you had Blu-ray, which is created by Sony, and HD DVD, which was a separate competing technology. And many movie production companies wouldn't put their movies into high definition for home use because they didn't want to spend the money to invest in production of both Blu-ray and HD DVD. So what they waited for, and we're talking about large um, movie um, production companies, what they would wait for was to see which technology was going to win out. Eventually what happened is the Blu-ray won out, and so whenever it was clear that Blu-ray players were going to be the standard, then production companies started creating high definition videos for home use. This is kind of a mirror image of what happened many, many years ago in the early 1980s with Betamax versus VHS technology. They both essentially did the same thing. They were tape players, you put them in your home. At that time, though, companies didn't use their investment timing option, and so they were creating tapes, movie tapes, both in the Betamax form and the VHS form. And we know what happened in that case. Betamax didn't survive, VHS won out, and all this production capacity that they created to create Betamax tapes was not necessarily worthless, but worth much less than it would have been otherwise. So that's why things changed with Blu-ray versus HD DVD. So how do we value a real option? Well, there's three different methods used to value a real option. The first is discounted cash flows. The second is the use of the Black-Scholes option pricing model. And the third is financial engineering. Financial engineering tends to be very specific to the situation or maybe to the company. So we're not going to worry about that in this case. We're going to focus, though, on the first two, discounted cash flows and the use of the Black-Scholes model. So here's the problem we're going to look at. Edison Motors has developed a car that can run on natural gas and has patented the new type of engine. And again, the reason why we have this option is they have a patent on the engine. If Edison begins manufacturing the car today, there's a 30% chance that gas prices will increase significantly, and the demand for the car will be high because the inputs are much more expensive, or excuse me, the cost of fuel will be much more expensive, so people will want to purchase the car that runs on natural gas, which would be less expensive than oil. There's a 40% chance that gas prices will remain stable and demand for the car will be medium, and a 30% chance that gas prices will drop, so nobody really wants to buy the car fueled by natural gas because oil will be cheap and it'll be less expensive to drive a gas car. These scenarios are shown on the following table. The NPV is the present value of future cash flows less the initial investment. If the company waits for 1 year, the cash flows will remain the same for each scenario. And I did that to keep things pretty simple. But the firm will be able to gauge whether demand will be high, medium, or low. If the demand is low, the firm will not invest in 1 year. The risk-free rate is 6%, and the weighted average cost of capital for the firm is 15%. So here we have our inputs. High probabilities, 30% of high demand, 40% for medium demand, and 30% for low demand. Excuse me. So I have a spreadsheet over here to demonstrate how to calculate this in Excel. It's pretty straightforward. We want to find out the net present value of 5 years of this cash flow with an initial investment of $12 million, with an initial investment of $20 million. And rather than use the NPV calculation in Excel, we don't need to do that. We'll use the present value calculation and then just subtract out the initial investment. So to do that, I'll put in PV. My rate is 15%. That's my weighted average cost of capital. My number of payments is 5. My payment, I'm going to make this negative so I get a positive outcome. And then I'm going to subtract out my initial investment. And then I just pull that down, and I get a net present value in each state of the world. To find out my expected NPV, I'm going to multiply my probability of that state of the world occurring by the NPV. Then I'm going to take the sum of those products to get an expected NPV of $5.48 million. So we could look at that. We could say positive NPV, fairly high IRR. We're looking at our initial investment, and we go to town. However, we might want to wait a year to see what happens to fuel prices. So in the first instance, we're going to look at the discounted cash flow model. It's just kind of a matter of timing. Instead of investing at time 0, we're going to invest at time 1, or we're going to look at the situation and see if we want to invest at time 1. So in order to do that, I put together a little timeline down here to show you what the cash flows will look like. We'd receive the $12 million for 5 years, but that wouldn't start until year 2. We'd make our initial investment year 1. And while these cash flows are risky, so we don't really know that we're going to get $12 million, but we expect to get $12 million if the demand is high for our product. However, this $20 million is not a risky cash flow. We know, or we should have a pretty good idea of how much we're going to need to invest for that. So we use different discount rates. So for the $12 million, the discount rate we're going to use is the 15%. And for the $20 million, we're going to use the risk-free rate of 6%. So the net cash flow for each of the following 5 years in each case would be $12 million in the first case, 8.5 if demand is medium, and then if demand is low, it's only going to be $2 million per year. The net present value, again, we're going to calculate this a little bit differently. We're going to put in the present value calculation, the rate being, again, 15%. The number of payments is 5. The payment is equal to -12. But then we need to discount that back one more year because we're investing one more year out. So if we calculated it just like this, we'd be finding out the value at time 1. What we want to find out is the value at time 0. So I'm going to divide that by 1 plus the weighted average cost of capital. And then we have our investment at time 1. But again, I need to discount that back to today. But that one's going to be discounted back at the risk-free rate because that's not a risky cash flow. Okay. That's referred to as the certainty equivalent approach. So we alter our cash flows individually based on the riskiness of that cash flow. So in that case, we get an NPV of 16.11. Just pull that down. Now, if this was the case and we're at a year and we're like, okay, we can invest. Well, we'd be happy to invest if the demand were going to be high. We get 16.11 million NPV. That's fantastic on an initial investment of 20 million. If demand is medium, we get an NPV of 5.91 million. Again, very good outcome. However, if demand were low, well, we wouldn't want this. We wouldn't want to lose $13 million. So we just choose not to invest. We just choose not to. And that's really the value of the investment timing option, is we get to see how things work out a little bit better, get an idea of what demand will be, and so we can choose not to invest and hopefully come out a little further ahead. We'll see how that works out here. So I'm going to multiply the probability by the NPV. I'll do that again here. And then in this case, we're simply not going to invest because our NPV was going to be negative. So our expected NPV is equal to $7.2 million. So I'm going to scroll up here and just fill in my table. So up here, we get 20.23, 8.49, negative 13.30, 6.07, 3.40, negative 3.99, and my expected NPV in the first case was 5.48 million. Scroll down here, I get 4.83, 2.36. Then in this case, I won't invest, so that's just 0. So my expected NPV is 7.2 million. So the firm will not invest if in 1 year the demand for the car is low. The expected outcome from making the decision to invest in a year is 7.2 million. The value of the option using the discounted cash flow method then is 7.2 million minus the initial amount of 5.48 million. Or the difference between the two is 1.72 million. So in this case, clearly it makes sense to wait and to have that benefit of waiting a year and seeing what happens to the demand for the car. Another popular method used to determine the value of real options is the Black-Scholes option pricing model. Now between the two, I kind of prefer the discounted cash flow model because you do get to see kind of a tangible dollar amount. However, there is a benefit to the Black-Scholes option pricing model that I'll show you when we get to the end of it. So when we use the Black-Scholes model, we need 5 different inputs. One, the S, or the stock price. And for that, we're going to use the present value of the project if it's undertaken in a year. So if we undertake the project at time 1, we're going to figure the value of that project. X is the exercise price of the project. For this type of a real option, what we would use is the initial investment, the 20 million, because that's our kind of our cutoff for investment. We need to earn a NPV of at least, or excuse me, we need to earn back at least 20 million discounted back to today, so that's our strike price. And then we'll use a risk-free rate of 6%. We need time. The time that we use in this case is the time that the firm has until the option has to be exercised. In this case, it's a year from now. And then the volatility of the underlying cash flows. It's not the standard deviation. I'll show you how to calculate that. It's somewhat complicated. So again, I set up a couple timelines here to explain what's going on. To calculate the present value of the future expected cash flows, which is what we do when we determine the value of a stock, we would start the project a year from now, but you'll see that there's no value down here. And the reason why there's no value is because when we purchase stock or when we value stock, we don't subtract out the current price. We just determine what the value of the stock is today based on the expected future cash flows. So that's what we're going to do here. We have a situation if the demand is high, if the demand is medium, and if the demand is low. And you'll notice in my Excel worksheet here, I don't have net present value. We're just determining the present value of these cash flows discounted back to today. So to do that, I'm going to put in here equals present value. My rate is again the weighted average cost of capital for the firm. The number of payments is 5. The amount of payment, I'm going to put in negative, so I get a positive number. 12, and then I'm going to divide that by 1.15 because the present value calculation would take it back to time 1. We really wanted it at time 0. So we get our values there. And I'm going to take the probability multiplied by the present value. Now you'll notice in this case that we do also include the low, the situation, or the outcome in if the demand is low, because we're not calculating the net present value. We're only calculating the present value to determine what the stock price would be today, or I shouldn't say stock price, what the value of the future cash flows of the project would be today. So I already have my present value amounts calculated here. So I'm multiplying my probability by the present value, and I get 2.49, 9.91, 1.75, with an expected present value of 22.15. So that would be my S value, my stock value in my Black-Scholes option pricing model. To determine the volatility of the cash flows, we would take the natural log of the coefficient of variation. So what we have to do is calculate the standard deviation of these returns, or these cash flows. We square that, add 1 to it, take the natural log, divide by time. In this case, is just 1 year. And then we'll take the square root of that to find the volatility. So the first thing I have to do is calculate the standard deviation. To calculate the standard deviation, we're going to use this formula. I've already partially filled it in. So we have 34.98. We just get that from right there. Minus 22.15, our expected present value, multiplied by the squared, multiplied by the probability. In this second case, we take 24.78, and again, minus 22.15 squared, multiplied by the probability of 0.4. In the last case, we take 5.83 minus 22.15, and we square that and multiply by 0.3. I'll do that over in Excel. You could certainly do that using a calculator as well. So I take 34.98 minus, to make my life easy, I'm just going to freeze this cell using the F4 button. Pull that down. So again, all I'm doing here, if you look, I got E17, so E17 is right here, minus F20, my expected NPV. I square that, multiply by the probability. E18, so that 850, oh, sorry, not 850, 2478 minus the 22.15, squared multiplied by 0.4, and then again I do the same for the last one. I take the square root of the sum of those numbers, and that gives me my standard deviation of 11.49. So this is the standard deviation, and that would actually be in a dollar amount. So my coefficient of variation is calculated as the standard deviation divided by the expected NPV. So I get 0.5186. So that's my coefficient of variation is 11.49 divided by 22.15. And so it's again 0.5187 on that. And so our volatility that we'll use in the Black-Scholes option pricing model is the natural log of 0.5187. You square that plus 1 divided by 1, and that's just because that's what time is. If it were half a year until we could make the decision, we'd put in 0.5. If it were 2 years, we'd put 2 in there, but it's just 1 year to keep things simple. So our volatility is equal to the square root of the natural log of the coefficient of variation squared plus 1 divided by 1. So it's 0.48812. So our inputs are, for the Black-Scholes model, the stock price is equal to 22.15. The strike price is equal to 20. The risk-free rate is equal to 0.06, 6%. Volatility is equal to 48.81%. And the time to the exercise date is equal to 1 year. And just for ease of computation, I'm just going to name these cells. So this is my stock price. And I'm up here in the cell name area. Second one is the strike price. The next one I'll just put in risk-free. Then finally, well, now put in volatility. Oops. The last one I'll put in is time. So our Black-Scholes option pricing model uses 3 different equations. The first one is D1, the second is D2, and then we use a value equation that explains what the value is. And I'll work through each one of these. So D1, I've got some of the items already filled in, so we know it starts off with the natural log of the strike price divided by the stock, the stock price divided by the strike price. So this should be 22.15 plus the risk-free rate of 6%, and our volatility is 0.4881. Sorry about that. We square that, and then in the denominator, we put in 0.4881. The ones are just where we put the time into the equation. So D1 is equal to the natural log of the stock price divided by the strike price plus the risk-free rate plus the volatility squared, and we're going to divide that by 2. multiply that by time. Yeah. And so that's our numerator. Our denominator then would be the volatility multiplied by the square root of time. And we get D1 is equal to 0.5764. Then D2 is equal to D1 minus volatility multiplied by the square root of time, or 0.08. From that we get ND1 and ND2, and these represent probabilities based on D1, the values for D1 and D2. And if you want to think about it, it's kind of like a z-test. So we get a z-test statistic when we're testing differences in variables. We're kind of doing the same thing here. And then we get a probability based on that test statistic. So D1 and D2 represent test statistics, and then the ND1 and the ND2 represent the probabilities of different things occurring. So in Excel, we put in equals norms dist. And what that means is that we're looking at a normal standard distribution, that's the S, and our value there would be the one for D1 of 0.5765. And then the second probability, okay, we'll put in norms dist, put in D2, we get 0.5352. So to fill in the sheet here, I get for D1 0.5765, and then for D2 I get 0.0883. ND1 is equal to 0.7179, and ND2 is equal to 0.5352. My last equation then is my value equation, and it says that the stock price today multiplied by ND1 minus the strike price, X, multiply or discounted back to today at the risk-free rate risk-free rate multiplied by time, and then we multiply that by ND1. Or, excuse me, ND2. All right. So in this case, my value is equal to the stock price multiplied by ND1 minus the strike price multiplied by, and we put an EXP negative the risk-free rate multiplied by time. And again, in this case, time is just equal to 1. But if we had a different time period, we'd put a different time period in there. And we multiply that by ND2. We get a value of 582, or 5.82 million. So what we'd want to do is compare this value to the initial outcome of 5.48. So in this case, we'd also see that the value of weighting is more than the value of just accepting the project as is today. So to finish up the sheet over here, our outcome would be 5.82 million. And I mentioned that there is an advantage to the Black-Scholes model, and I wanted to demonstrate what that was. And it's just a relationship that we see between volatility and the value of the option. So our volatility is based on the standard deviation, or kind of the spread of the returns or the outcomes from the project about what happens in the future. And I want to demonstrate how that volatility impacts the value of that investment timing option. So I'm going to use a data table to do this. For the data table, I put in the value of the option. And then I want to see how the value of that option changes with the volatility of the option. So I'm going to start here at 0.3. Sorry, 0.2. I'll go to 0.25, 0.3, 0.35, and so on. I'll increase this up to about 70%. Using a data table, I can see how the value of this option would change with the change in the volatility. Now, it was important that I, instead of just typing in the number here, that I actually put it equal to the value, because this has all the equations in it. So I highlight that information, I go to Data, I go to What If Analysis and Data Table, and I select the column input cell because this is in a column. And the variable I'm changing is volatility, so I want to select that cell. When I do this, what's going to happen then is it's going to tell me what the value of the option would be at these different levels of volatility. Okay. And you can see here that the value of the option changes based on the volatility of the underlying cash flows, or in this case, the underlying outcomes. So what we see is that if the volatility, keeping everything else the same, the volatility were only 20%, we may not want to pursue this outcome, because just accepting the project today is worth 5.48 million. Accepting it, if there's only 20% outcome, is only 3.8 million. We may want to just go ahead and accept it today. But as we increase the volatility, or the riskiness of the outcomes, that investment timing option becomes more and more valuable. So that finishes up this presentation on real options. I hope it's useful for you. Let me know if you have any questions.